Okay, Chapter 4, Securities Markets and Market Indices. So here we're continuing. In the first couple of lectures and chapters of this book, we're just laying a framework or a baseline of some common knowledge in the markets. It's fairly easy, fairly routine stuff. As the chapters progress, it's going to be becoming more difficult, more calculations, a little bit more computational work, which I guess is the same as calculations, more complex ideas, and a little bit more application of applying those ideas to the marketplace. So why are financial markets important to society and the governments? So the financial markets is what enables money to move around in the system. Think of money like the oil in a car's engine. So the financial markets are like, or the circulatory system of the human body. It's like, gets the blood going and moved to where it needs to be, or an engine moves the oil to where it needs to be so the car can perform at a high performance. So think of the economy like an engine and the money like the oil inside the engine. And the financial markets are what is the pump to move the money around like the heart or the circulator in the car. Now, for firms and governments, they need money. Actually, individuals are the net savers of the economy for the most part. And firms and governments are net borrowers. So companies need to borrow money. They need to do an IPO or issue bonds. Most governments run in a deficit. They need to issue bonds and raise money as well. So that all comes from individuals who save. And the individuals who do save are investors. So they are able to share in the prosperity of governments and firms and businesses when they lend the money or invest in those enterprises. And the financial markets help direct the money to the most productive or efficient places. So when a company is doing very well and their returns are doing well, more money will flow to them as far as their capitalization, but it also will make it easier for them to issue additional stock or issue bonds and receive even more money to grow even faster. So if you have a very hot restaurant like Shake Shack, and they currently have 63 locations, and they want to expand to 400 locations, they do an IPO to raise $1 billion. They do bond issuing to raise X amount of money, so they can open their locations and grow while the company is doing well and people like their products and there's a good buzz about them. It's a common sense. And it actually helps lower the cost of the exchange of money. So everything is standardized and works through an efficient markets using supply and demand, so the actual cost of the capital is lower. And for economies, it helps to, for companies, not just any company can do an IPO or do a big bond release. So generally, the best companies who have the most optimistic future are the ones that get the opportunity to borrow or raise capital, because they have the best opportunity to generate returns for investors. So it keeps the economy in top shape, the financial markets, because they're always judging different aspects of the economy. So the financial markets, if investors, they have a conduit or medium to reach and invest in companies. If companies aren't doing well, the financial markets will, starve them. They won't provide them with, they won't be able to do an IPO because no one wants the stock, and they won't be able to borrow money because they're so risky. So the money will flow to the better operations. Now, new securities are listed in the primary market. And we call those generally for stocks an IPO, initial public offering. So the primary market, think of the primary market sort of like the bookstore on campus. So you go there to buy, you can go there to buy a new textbook. And you buy that new textbook for the class, and the textbook publisher gets the profits from that. But not only is the campus bookstore a primary market for buying a new book, it's also a secondary market for buying and selling used books. So if you want to take your textbook and sell it back to the bookstore, and then they're going to sell it as a used book to another student the next semester, that would be an example of a secondary market. Now, the textbook manufacturer doesn't make any profits from the sale of used textbooks. That's why when you buy a new textbook, say you buy a textbook for this class, it's $200. But if you buy the online edition, it's $60 because they know you can't reuse or resell the online edition. So the reason the textbook prices are so high for the primary market is because they only get to sell it once, and then it can be resold 4, 5, 6 times. And that's why the prices are so high on textbooks. If all parties agreed not to sell used books, the textbook companies would sell more textbooks and they would be able to lower the price of the textbooks. It's a similar dynamic in, say, GameStop. If you want to buy a new Xbox or PlayStation game, it's $60. However, you can sell that game back or buy, that's the primary market, the brand new $60 game. But they have a secondary market at GameStop, which they derive most of their profits from, where people sell them the used games and then they resell the used games to other parties. And they could, that game could be sold and resold by GameStop multiple times. And they make a much bigger margin on the reselling of old games than the new games. Maybe they have a 10 or 15% profit margin on the sale of a brand new game, but they could have a 30 to 50% profit margin on the sale of a used game. So those are just 2 examples in your world, the textbook store and GameStop, of primary and secondary markets. So the primary market in financial markets is where things are first sold, bonds or stocks, and the company will receive the money for selling those financial instruments to investors. Now, this primary market is facilitated by investment banks. So this is one big area of what investment banks get involved in, is they will do all the legwork to issue an IPO, to issue a bond, which means all the legal work, all the regulatory work, all the networking work to gain access to the capital, so they can guarantee that all the shares will be sold, because they have a network of other affiliated investment banks and other brokerages that can easily push out these stocks to be purchased. And they're so efficient at selling these IPOs that there's never anything left for the ordinary small investor. So all the big institutions buy up all the shares of the good IPOs. And you, as a small investor, if you want to get into an IPO before it's launched, you can't. It's virtually impossible. It's possible, but virtually impossible. But you could buy it the first day in the secondary market. So in the first day of trading, people who got the price at the IPO price, say $17 or $20, and now it's trading at $50 in the regular secondary market, and they sell it. Now you're buying it from them in the secondary market, but you're paying a much higher price than the initial IPO. So who's buying all these shares of the IPOs? Big players like Fidelity and Charles Schwab and big retirement portfolios. These big institutional investors who belong to a syndicate and are associated with investment bank will say, yeah, we'll take 5 million, we'll take 10 million shares, and they buy all that up. Now, it's the investment bank. They get compensated very well for packaging and selling these IPOs. And they can either take a straight out commission or they can take a piece of, get paid in shares of stock. So the investment bank often wants to keep the initial IPO price low, so that way when it does open, there's a pop of 15 to 100% in the price of the IPO, so that way all the parties that they've sold the IPO to have made money and are very happy. So that's sort of their motivation. Now, as a company, you want the opposite. You want to price the IPO as high as possible because you want to get as much money the first time you sell the stock. So you're not so, you don't really care that the stock, it's nice that it went up 50%, but you're looking at it, that's money that I should have had because that is the demand that people would pay for the stock that I didn't get as an IPO. So let's look at the IPO market. Let's go back to the year 2000. And in the year 2000, we had a record equity of IPOs, $223 billion in U.S. stock, and 391 IPOs, which raised $61 billion in that year. Then in 2002, after the internet bubble burst, the number had dropped from 391 to 97 IPOs, but only raised $27 billion. Because when the economy and the stock market is not hot, you don't want to bring your company public. And this is one of the reasons Google was ready to go public at this time, but they waited until a better stock market because they could get much more in a bull market than in a bear market like in 2002. So many companies will hold off on their IPO until the market timing is right, where the market is like right now. Right now there's a lot of IPOs and the market's good. So companies want to bring out their IPOs now while the market's still good. But if the market turns and goes sour, we could see in 2010 we had $36 billion was raised. In 2011, $34 billion was raised. So it's still not at the height of 2000, which was really the height of the IPO markets because of the internet. And there were so many internet companies. They were becoming public as an IPO without any profits, without much sales, just with a nice concept, which was a rarity. And that has reversed. Now companies go IPO, must have profits and sales and an established business. It can't just be an idea like it was back. People were so hungry for these back in 2000, they'd pay for anything. But there's really very little, if no shares available to the small investors like us. Now let's talk about the investment bank. This is where a lot of students come up to me and say, I want to work for investment bank. Professor Nugent, make that happen. And I said, well, I wish I could get you a job at an investment bank, and unfortunately, I can't. But if you want to work in an investment bank, there's a lot of competition. So you're going to have to develop some inroads with them ahead of time. Seek out people who may already work there, or try to go to their websites and see, do they have internships available? Do they have special events? A lot of these investment banks have, I know some of them had, that I heard from the Career Center, they usually have this information. Some of the investment banks have a special day for minorities to come in and see the investment bank in a career day. They had, I think one of the banks had a career day for LGBT people. And so they do have sometimes they do have some special interests, operations, and they do have some, and then they also have networking and different events for everybody. As a finance person, though, the easiest way into an investment bank, there are two tracks. Track one is Ivy League school, Wharton, Harvard, Yale, those type of schools. They seem to have a lot of connections and a direct conduit into a lot of those jobs in the investment banks. Track number two is you get your CFA. So the CFA means if you have a CFA, they don't care what school you went to, because now we have a test saying that you're one of the top 1% of financial people who have this qualification and a credential, and that will definitely make it much easier to get a job at an investment bank. Because you have something a lot of the Ivy League people don't. And many of the employers respect the CFA more than the Ivy League degree. So that's another way, if you want to spend the extra effort to start getting engaged in the CFA exam, that's another way to get into an investment bank. And like I said last week, I was looking at LinkedIn, and I've had approximately 5,000 students that I've taught in the past 10 years or so, and a surprising number of them are placed at top banks in Manhattan and investment banks as well as mutual fund companies. So I know that students from this program have been getting those jobs, but they haven't been handed to them. They had to work very hard for them. In some cases, they had to start in a lower position and work their way up, and in some cases, they had help from people that they networked with. I talked to one student who wound up being a vice president of a very big bank, and actually two students, and the other student was the Royal Bank of Canada or some such thing. And I asked them, well, how did you get these jobs? And they said, well, you know what? I was friends with students in the MBA program who had graduated a year or two ahead of me. And I just looked them up after graduation, and they helped me get a job because they had already got into the bank, and they helped bring me in. And I had known them from either teamwork. That's why teamwork in the class projects are good, because you get to know people and establish relationships. And these two people I think were on the MBA Association, so they also knew each other from that. That's back when the MBA Association was about 40 students strong, and the meetings were pretty involved. Now, it's a different story now. It's not quite as involved. But just some hints for you if you wanted to get a job at these investment banks, things that you can do or think about. But you definitely want to start thinking and planning now. Don't graduate and then try to apply. because their applications, since most of the, when you apply for these places, it's electronic, they'll get probably 5,000 resumes. And then they'll use an automatic sifter to go through, okay, these are the schools we want students from, and these are the GPAs we want. So they won't even read your resume. They'll just say, you're not on our list of schools, or you haven't made the GPA requirement, and then you're just not even considered. So that's why you have to think of a more creative way to get yourself known to get into some of these big jobs in Manhattan. Another criteria is CFA. If you have a CFA, that's scanned right away, and only probably out of the 5,000 applicants, probably only 5 to 10 have a CFA. Okay. So what else do investment banks do? So there's so many jobs at investment banks, and not just financial markets. There are jobs in many different localities and positions in an investment bank. A very big organization. A lot of what they do is client advice, and where they different features of securities, offering timing a sale, and that would be the client of the IPO. So the client advice, if you're coming in, you say, I want to do an IPO, the investment bank can do any different types of features of the security, the offering price, the timing of the sale. They'll provide you all this advice. Okay, this is when we think the market's best for your company. This is what we value your company at, and it should be how many shares you're going to issue, and at this price, and what type of classification of stock. They can do all that for you. And the underwriting service. So they will guarantee, they'll take the risk of selling to investors, so that way you don't have to worry about if you want to issue 5 million shares, they can take the risk out of those not selling, and they'll guarantee that those are going to be sold. But that comes at, you're going to have to pay them a little bit extra for that guarantee. They'll coordinate the marketing issue. They'll help with the registration with all the Securities Exchange Commission and the government and the IRS. They'll issue the prospectus, and they'll sell the securities. They have the investment bank syndicate, where the investment banks and the brokerages and the mutual funds all kind of work together. So they have, those are how they sell it, because they have connections to everybody else. So if there's a hot IPO, the investment banks, the other investment banks want to be involved too. So if it's a big IPO, that one bank may not be able to handle all of the sales of all those shares. They'll bring all their buddies in from all the other investment banks and their other syndicate to help sell the stock as well. And that's how they can guarantee it. Now, the prospectus is issued as sort of a tell-all about the stock that's going to come out. So before you buy the stock, you want IPO, you need to read the prospectus, because that gives you the financial statements, the management statements, the company's profile, what products they sell, all about the companies in this prospectus. And once it's issued, then the quiet period becomes where no new information can be released until it goes IPO. So no one gets an unfair advantage about the company. And that could be anywhere from 1 to 6 months in between, hopefully not as long as 6 months. But the prospectus is what you buy as an investor to get an idea whether or not you want to buy these IPOs. Now, not every IPO is a pot of gold. Some IPOs come out and they tank. They go lower than the IPO price, and they just don't do very well, and they misread the market or investors' interest in that. Now, investment banks can also facilitate a private placement for companies and securities that are sold directly to investors and bypass the open market. So you could, most every company has stock, but it's just not public. It's private stock. So the investment bank can, some companies can just raise money by selling stock privately to a couple of very wealthy individuals or organizations. So if they want to go through the time and expense and the money and the regulations and the new accounting requirements to go public, they can also stay private and just issue shares in the private forum. And investment banks have done that for a lot of companies that just didn't feel that the IPO was right for them. So no registration is required. You don't have to deal with the SEC. It saves a lot of time and money, and it's typically a lot lower banking fees from the investment bank if you do a private placement. But on the negative side, there's not as much capital or money available in the private placement as there is in the IPO. Okay. So the secondary markets, I began earlier talking about this when we mentioned the primary markets, and it's basically an auction-based system where people can buy and sell basically used stock. we don't call it used stock, but since I said used textbooks before and used video games, think of it as used stock. So the IPO is a brand new shiny stock you buy, and then when you want to sell that to somebody else, it's used. So it sells in a secondary market in a bid and ask supply and demand format. So the more people who want to buy the stock, the orders go in, and if there isn't enough people wanting to sell it, the price rises until it encourages people to sell it so that they meet an equilibrium. So supply and demand is what moves the prices up and down in the secondary market of stock. Same thing for video games. If there's a very hot video game that people don't want to sell back because they like playing it so much or they want to own it, then the price of that, the used price goes up as they're trying to encourage more people to sell it back. And as you know, if everybody kind of, there are some times where some games come out and they're very popular and everybody gets a copy, but it winds up really not being that great, so they all kind of sell it back at the same time, and those prices go very low. So if you're familiar with that, that's the supply and demand. All right. So some of the markets in the secondary market, you have the New York Stock Exchange. It's a secondary auction-based market for equity shares. And we all know about the New York Stock Exchange. It's a non-for-profit organization of members, and they have listing requirements. And I think I guess I put a web page here to give some of the listing requirements. I put a link in the presentation. Hopefully it comes up. To get on the New York Stock Exchange, it's one of the best exchange to get onto. And I don't think you can kind of see this. So the New York Stock Exchange, you have to have pre-tax income of $2 million. 2-year average pre-tax income of $2 million as a minimum. The Nasdaq is $1 million as far as the Nasdaq area. We're familiar with that. And then the Amex, the American Exchange, which is now part of the New York Stock Exchange, that's only $750,000 in pre-tax assets. Now you can get you have the New York Stock Exchange, but the Nasdaq is part of what we call over-the-counter. So Nasdaq is one part of the over-the-counter market. There are other over-the-counter markets like the bulletin boards, which is back here. So over-the-counter bulletin boards, and they don't have as many, if any, listing requirements. Okay, so you can look this over at your own leisure to kind of get some of the differences. But just the important thing here is to know that not each exchange has a different set of requirements for you to become part of their exchange. And for these exchanges, if your share price falls too low, they will remove you from the exchange. So that's why they kind of invented this reverse stock split. So if your stock price, say, goes to $5, nobody wants to buy a stock that's $5 or under because they know that those aren't really great, typically are not great performing stocks. So when this happened to a company like, say, AT&T, they did a reverse stock split, 5 for 1, to get the share price back up to $25 and stay on the exchange and also seem more respectable to potential investors. A lot of investors feel that if the price is too low on a stock, it must mean that there's something wrong that people have sold it so low. And generally, a lot of times, they're right about that. Now, in the New York Stock Exchange, we have specialists who are assigned to trade the equity to make a market for the stock. So specialists are assigned, and they basically create a marketplace for supply and demand to trade the stock. A lot of this is all done on computers these days, though. So it used to be a very physical world where there were tickets and people would stand at posts and everything was yelling and shouting and hand signals to trade the stock. But today we live in a modernized society, so there's much less of that, and there's much more of electronic help in actually trading and exchanging shares on the marketplace. The Amex used to be a separate American stock exchange located down the block from the New York Stock Exchange that operated as a separate exchange, sort of like a smaller specialized exchange dealing with a lot of warrants and options and closed-ended mutual funds and ETFs. But recently, it was purchased by the New York Stock Exchange. There's also what they call regional exchanges, which are mini New York Stock Exchanges placed around the country, say in Boston, in California, and Philadelphia. And these are just, when it was a physical world, sometimes the New York Stock Exchange would get overwhelmed, and these regional exchanges would help with buying and selling of the shares. And it also helps for time zone differences and things like that. So there are these smaller regional exchanges as well, but they're all tied to the New York Stock Exchange. The New York Stock Exchange is considered the elite, the most respectable exchange there is in the world, and has the most liquidity and the most money flowing through it generally. But there's also the Nasdaq, which is its biggest rival. And they have dealers will trade and list the securities. So instead of the specialists are like the dealers are like the specialists of the Nasdaq. And they basically, the Nasdaq runs completely on computer. There's no physical trading site. Sometimes you go to Times Square and you see that big Nasdaq sign. That's just a studio. I've been inside of it with a class before, and what they do is they have a big wall where they talk about stocks. They have a news studio in there, but no one's physically trading stocks in there. It's all advertisements. When you come to Times Square, you see their big ticker board, and it's just to promote the name Nasdaq in the marketplace. But there's not actually any trading going on there. All the trading is done by computer through an internet-like service. So it's just linking computers together, and a market maker is someone who just facilitates the trades. They connect people who want to buy the stock to people who want to sell the stock. And how do they make money? The commission, the difference in between. So stocks trade as a bid and an ask. So an ask is, say, $5. The bid may say, as an exaggeration, $4. So the market maker will buy the stock from you at $4 and then sell it at $5. So the market maker buys in the bid and sells in the ask. You buy at the ask and sell at the bid. Go back to the example of the textbook store or the video game store. When you go to the textbook store, when you sell your used book back to them, you're not going to get the same price if they're going to turn around and sell it to another student next semester. You're going to get the lower price. If you go to GameStop, they'll pay you one price for the game. You maybe want to return Destiny. They'll give you $20 for it, then turn around and sell it for $35. So think of that business philosophy. They're going to keep GameStop, and the bookstore keeps the spread, the difference between the buyer and seller of the copies. The same thing in the marketplace. Now, it's an automated quotation system. That's actually where the AQ at the end of the NASDAQ comes from. It's National Association of Securities Dealers Automated Quotation System. And there's no fixed number of participants. So anybody who wants to be a market maker, once you fill out the proper paperwork and pass the SEC requirements and things like that, you can go up and set up shop and start trading a stock. So it's all very much competitive and supply and demand. So if you have a company like Cisco Systems, you could have 60 market makers working that stock, and the spread could be as down to 1 penny. Or you could have another stock that's very uncommon. There may only be 1 or 2 market makers, and the spread could be 50 cents to $1. So if a stock is trading, it may not trade. The reason there's only 1 or 2 market makers is because the stock does not trade much. When a stock starts to pick up in volume and trading, and a lot of profits are being made, other people pick up on that quickly, and they move in and become market makers as well. And the market maker basically has to facilitate, manage the inventory of the amount of people who want to buy and who want to sell. And they place their prices on a list. So whoever has the best prices goes to the top of the list. So if you're a market maker and your prices aren't good, you're at the very bottom, because the SEC requires that the lowest price, asking price, has to be sold to the consumer first. So whoever wants to discount the shares, the most will be the one who's selling them. So to keep things fair and honest for buyers and purchasers of stock. Now, inside the NASDAQ, they have a national market, which is where we hear the most about. They also have a small cap market. And more firms are actually listed on the NASDAQ than on the New York Stock Exchange. But most of them are much smaller and have a much smaller market cap. And this electronic network can connect these traders around the world all together. So you could be anywhere in the world and be a market maker for the NASDAQ. So the NASDAQ is just one piece of what we call the over-the-counter market. So the over-the-counter market has just been a mechanism to sell securities for a long time. But it always had a bad Wild West type of reputation. So they decided to come up with that name NASDAQ, and listing requirements and an advertising campaign and a media shop on Times Square to promote it as a more secure, a different type of over-the-counter market that was more similar to the New York Stock Exchange. And it worked. The Nasdaq became a big player once they put in the marketing effort and they cleaned up the stocks listed on the Nasdaq area. It became a very successful venture. But the over-the-counter market also has a bulletin board market, which is for much smaller companies with almost very little to none listing requirements, and they just do the minimum SEC filing requirements. There's even a more riskier area in over-the-counter market called the pink sheets. And you could, if you open up this lecture at home, you could go to that website. And the pink sheets is the penny stock area. So the 1 to 25 to up to 99-cent area stocks will trade in this penny stock, pink sheets area. And you see that movie, The Wolf of Wall Street, with Leonardo DiCaprio? That's what he was trading. He was trading on the pink sheets, these penny stocks, where the commissions they were saying are 50%. And it's really all crap. It's all high risky, highly speculative. None of those companies have much of a chance of being anything. And it's unregulated, and it's just a really sucker's bet, these pink sheets. So have some people made money there? Yes, some people have. Most people haven't. But you could check out. There's also, through the over-the-counter, these ECNs, Exchange Traded Networks. These are additional mechanisms for trading stock before and after the close of the market. So the stock markets open at 9:30 and close at 4. And the reason they're 9:30 to 4 is because traders will get in at 8:30 and they need to set up and get ready. And then it closes at 4 because after 4, then the traders have to do some work and some close out. And so their hours could be 9 to 5 or 8:30 to 5. So that's why the market isn't open for a full 8 hours. And because the market was very physical in the past, it had a limitation. It could only really be open from 9:30 to 4. It was a very physical market. And they've hung on to those trading hours. But in the electronics world, it could really be a 24-hour market. So these ECNs were created to trade stock after the traditional trading hours of the 9:30 to 4. The one reason they kind of stick to these trading hours also is because they have rules about when companies can release information. So they generally don't like or allow companies to release big information during the day of the market. It usually is open, the information comes out before the market opens or after the market closes to give everybody a fair chance of reading it and thinking about it before they trade the stock. Okay. Again, we're going back to foreign markets. The U.S. isn't the only one with exchanges. So the U.S. equity markets are actually becoming a smaller and smaller piece. They used to be greater than 50% of the world's equity or stocks were traded in the United States, were United States companies. Now it's less than that because many of the world's other economies have grown up, and stock markets in India and China and Japan and Germany have become big places where a lot of equity is now traded. Even the emerging markets have more stable political systems, like Brazil, lower regulation, more standardized trading activities. So even the brink countries, as they call them, Brazil, Russia, India, China, they're becoming more respectable and a place where a lot of equity is flowing to. But the reason to be invested in these foreign markets is so that you have more diversification. Now, there are more risks in these foreign markets, such as illiquidity, a difficulty for trading your stock when you want to. Liquidity is about how quickly you can convert your stock into cash. You know, some assets are typically stocks are pretty liquid. Real estate is an example of something that's not very liquid. It takes a lot longer to convert to cash. But in the international market, sometimes you have a lack of information. There could be political uncertainty. I mean, there are stock markets in Egypt and Greece and Iraq, but very few people right now would really want to invest in some of these markets because of the instability of these countries. Okay, so let's move into equity indicators. So we have the big daddy is the Dow Jones Industrial Average. This is created long ago, and it only includes 30 stocks. But to be fair, when this was created, those 30 stocks that were in the Dow were a significant portion of the equity cap of the marketplace. You know, so it really was a pretty close representation of the market. Now, this is what we call a price-weighted index, which isn't the best way of calculating an index. Essentially, we add the price of all 30 stocks together and divide by 30. The problem with this is it doesn't reflect the amount of outstanding shares of the total market cap of these companies. It's just going by the share price and a divisor. Now, this divisor over time had to be adjusted for stock splits and stock dividends. So the Dow Jones Industrial Average, their divisor, has changed throughout the years to compensate when the stocks on the exchange have, either in some cases they may have merged with other companies, or they may have had a stocks spin-off, which lowered the shares of the company. So anytime the company's per share price change due to something other than supply and demand forces, they have to adjust the divisor so there's no effect on the average. So if a company has a 2-for-1 stock split, we don't want to see the Dow Jones Industrial Average go down because of that, because it really isn't going down. So the divisor will be adjusted to make sure that doesn't happen. So generally, the Dow 30 are the oldest, most well-known, stable stocks you can think of. And the big criticism today is that it doesn't really represent the broader marketplace. So the overall market isn't fairly represented in these 30 stocks as they used to be, because there's so many great companies out there now that 30 is really too small of a number. And the other problem is that it's because it's price weighted, it's not a fair representation of the wealth being created, because you're not factoring the amount of outstanding shares. So if we evaluated index or average is a much more closer representation of the wealth being created. Then we come to the Standard & Poor's 500. Now this is a much better index to look at, because this one is value-weighted index. They do take into account all of the outstanding shares and the stock price in valuing the index. This is, we're going to actually do these calculations next class. We'll actually have a handout and I'll have to do these calculations. Now it's 500 of the largest firms, so it's a much broader representation of the marketplace. So that's why the S&P 500 is what you should look at on a daily basis to see how the market is doing and how they've increased or decreased their wealth in one day, rather than looking at the Dow 30. Okay. Now, the New York Stock Exchange and the Nasdaq also have what we call composite indices, which are value-weighted indices of a broad measure of companies that the New York Stock Exchange composite is just companies on the New York Stock Exchange, just like the Nasdaq composite is companies on the Nasdaq. Another popular one is the Nikkei 225 average, and this is another price-weighted, sort of like the Dow of Japan. The Russell 1000, which is like the S&P 500, but instead of having 500 stocks, it has 1,000 stocks. So 1,000 large-cap stocks. So the Russell 1000 is considered an even broader measure than the S&P 500. And then we have the last index is a Europe, Asia, and Far East index. That's sort of what those acronyms stand for. And that's an index for the broader world markets. And these are all important because investors want to know, well, how is the market doing? I mean, I think a more important question is I don't care how the market's doing. I want to know how my stocks are doing. I want to have great stocks, so that even if the market's doing bad, my stocks are going up. So the focus should be on the stocks you own, but a secondary focus could be on how markets are doing. So it's a little consolation if the market goes down 10% in a day and your stocks went down 5%, you could at least say you're doing better than the marketplace. Now, bonds also have a secondary market where bonds can trade back and forth. So they have a primary market where a bond comes out and the company receives the money for the bond. But then after that, you're free as the bond owner to sell it to somebody else, because it's an asset. If you no longer want it, you can sell it to somebody else. So it'll trade in the exchange. And the New York Stock Exchange does have features to do an automated bond trading system to execute orders, mostly corporate bonds. The treasury bonds are the most active bonds in the world, the biggest market, and they have dealers in their marketplace as well. And municipal bonds aren't traded as actively as treasuries, but there's still marketplaces where those trade. So if you wanted to buy individual municipals or treasuries, you could do that. However, most people find it much more convenient to buy treasuries or municipals inside a closed-end or open-ended mutual fund or even an ETF. It makes it a lot simpler than It also diversifies you where you're not just getting one particular bond that could run into problems, you're getting a few dozens of bonds at one time. Okay, so there is a class handout. We're not going to do that today. We're going to do that next class. But this is a spot where I would usually hand it out. I'm just going to keep going with the lecture. I have something else planned for today that we're going to get to in a minute. Actually, we're going to get to now. So let me just end this.